Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Robert Conzo, CEO and Managing Director of the Wealth Alliance. Robert, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Glad to be here.
And stock valuations are historically high, but the Wealth Alliance remains bullish. Give us some background. Tell us why.
Sure. It's obviously been a very interesting year and a half. There are lots of things that are going on, and obviously we know that the basic ones is incredibly accommodative Fed that is making it hard for anyone not to invest in equities. That's number one. The consumer is incredibly strong. They've gotten a ton of money from the government. They saved a ton of money during the pandemic, those who had their jobs and kept going. So you got a very, very strong consumer. You got a very, very accommodative Fed. And you have a consumer that also wants to get out and spend in a big, big way. So when you put these together, what you're getting is people just pouring money into the market. And I think that trend is going to slowly continue. Now, it slowed down. We saw a big 2020 and obviously into 2021, but now it pulled back. Since May to now, markets are pulling back. Ironically, the Nasdaq since May is going up, but that's because there's a rotation to growth. So we're still bullish on it. Not as big as it once was. I don't think we're quote unquote going to the moon. But I do think we're going to see a lot of this with a little bit of upward trending in the future.
And we're in the middle of a global economy recovery, as you said. Are you concerned about the trajectory with the emergence of COVID variants? In other words, are we being set up for a bear market on the horizon or just a little bit of chop?
Well, there's a statistic that we saw in Barron's that was so interesting, and we really got into it a little bit further. Right now, the market for 5 quarters straight has been up. That hasn't happened since 1961. That's only happened 17 times. And after every single time, 17 out of 17, the market 1 year out continued to go up. So I think what you're seeing between that, between the consumer, between low interest rates, the thing that's giving us pause right now is the PE valuations. They're high. And we all know that. The Dow is around 24. I think the S&P is around 36. So valuations are high compared to traditional, which is around 16. So because valuations are high and there's a lot of uncertainty, Biden's tax plan, the Fed's interest rates, what is going on with wages, and now the COVID variant, the variant, it's tough. So we have even more uncertainty. So I think that's what's going to create the chop that you're talking about. But we don't see the seeds for a bear market. I don't see that happening.
So Robert, with this backdrop, what are you owning here? Growth or value or a combination of the two?
Yeah, that is another very interesting story. So at the end of 2020, we had, we all saw, that rotation out of value into growth. And it was happening, actually I said it backwards, out of growth into value. And that's what we saw at the end of 2020. Now, what you're starting to see is the other way. And that's why the Nasdaq from May to now is going up. It's a more growth heavier indices. So we're starting to see growth take shape, and that's because the 10-year Treasury took a giant drop from 1.7 down to 1.1. And at the end of the day, we know growth companies are discounted future cash flows, and their prices reflect that. Growth is going up. So take away all the detail. You look at a value index, Vanguard Value Index up 18, Growth Value Index up 18. That hasn't happened in 10 years. So I think what you're going to see a more dispersion, and we are not picking and choosing. I think diversification is the name of the game, and it's working out very well.
And you think inflation numbers are warped a bit here. Why is that? Is inflation a longer term issue? And how do you think this will impact rates?
Well, there's a reason why people are very concerned about inflation. The CPI in February was at 2.3. It's now at 5.4. In June, it had the largest jump, 0.9%, which hadn't happened since 2008. So I get it. I understand why people are concerned about inflation. But there's many things that kind of go against that. Number one, there's pockets of inflation, airlines, autos, travel, things of that nature. But there's a lot that aren't. People's mortgages, everyone refinanced. People are paying very little. Rents are getting lower because people, especially on the low end of the income scale, having a hard time paying rents. So at the end of the day, there are pockets of inflation and there are ones that are not. I think that's one. I think yields at the end of the day, the bond market is telling us they don't believe there's inflation. The yield went from 1.7 down to 1.1. That's a 30% drop in bond yields, and that's because bond prices went up. People are buying bonds, and at the end of the day, they're worried about a market pulling back. That's not an inflationary driver. That's number two. And number three is I'm on the side of the Fed. The Fed's telling us we're staying dovish no matter, the whole world is pushing them to raise rates. They're still holding it. So I think it's transitory to some degree. There will be some areas that stay up, but I'm staying there. I think it's okay.
And Robert, as you know, the market's always worried about something, right? How concerned are you about China and the restrictions it's putting on Chinese-based companies to use only materials from Chinese-based companies? This is sort of a new worry that has entered the marketplace.
Yes, it's a new worry. I think people have been talking about it for eons. But, you know, we were doing so much business in China. And things are going so well in China from the sense of many, many big corporations, as you know, Jill, have put billions and billions of dollars in infrastructure in China. Now, what we're starting to see is they just came out with a memo in May, basically saying, we want to use Chinese materials only. It started in the medical field with X-ray machines. Now, what we're starting to see is that may be more prolific, which is becoming very eye-opening to American corporations. At the end of the day, what we may see is big American corporations starting to think twice about how much they have in a communistic society versus a free society. We may be pulling back more into home or working with countries that are a little bit more friendly. And I don't think that's necessarily a bad idea because we don't know where this is going with China, and they could, at a click of a button, cut people out. That's scary.
Yeah. All right, Robert, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.